Okay, welcome everybody to this advanced family law software webinar. And what we would like to do today is we're not going to go over individual state child support guidelines. We're going to be looking at the more sophisticated portions of the program. My goal today is to introduce you to oh, I didn't know the program could do that. Or, oh, that's a cool report. I'm going to have to remember to use that. Or to even raise your curiosity to say, let me explore the program further and see how else it can meet my needs. So we're going to start out looking at all the various reports that are available in family law software. And I apologize in advance. My throat is a little dry this morning. And my doctor says I need to hydrate more. So I will be sipping on my tea, which is very hot throughout the program. Okay, so let's talk about the reports. We're going to go into the reports section. And by the way, before we start, this is the new cloud interface. For those of you who have the desktop or had the cloud and haven't opened it in the last 5 days, we've moved the tabs from the top down the menu on the left side. And each of these menu sections correspond to what used to be a tab. So settings, reports, analysis, enter data. We're going from bottom to top. And we now also have a new feature of File Manager, which we can talk about if we have time at the end of the program, but we'll have a separate little video on the website about File Manager if you have any questions about it. It's very cool. Some very cool features. Okay, so in the Reports tab, we have some frequently used reports. The ones on the top will change depending on the state that you are in or working in. And then these ones under reports will be the same, except that in some states it might say community property instead of marital property, community and separate property. And these four are the basic reports that people use a lot. Although I will say that oftentimes people don't look at or understand the View Edit Taxes report. So I want to start there. The first thing you will see on the View Edit Taxes report is a bunch of years at the top. What that is telling you is the program has the ability to do projections and to go out up to 50 years in the future. Any tax law changes already in the program, already in the law rather, are already in the program. So the Tax Cut and Jobs Act changes that went into effect in 2017 that go for 10 years will sunset for 2026. And those changes will continue to be there. We can go into settings and go into assumptions, or you can go into reports, more reports, and access the assumptions page there. And at number 2 here, you can set the number of years for cash and net worth projections, and that will go out as many years up to 50 as you want. I have it set right now for 10. It's a good number. We'll go back in and look at that more later. And then you can see at number 3, we already knew that those sunsetting provisions of the TCJA, the Tax Cut and Jobs Act of 2017, might be revisited by Congress. Although currently my hopes are not high that they will get anything done. However, if that changes, it will be very simple for us to go in and make those changes go back or extend. However, you don't have to worry about that now. This also allows you to set assumptions for program-wide, and we'll get back to that in a moment. But let me go to the reports, View Edit Taxes, where we were. And what this page is a pro forma tax return for the current tax year and any future tax years. if I put in 2021 financial information and I want to see what their tax return should have been like for 2021, I would go back in and change the start year. Again, settings, assumptions, change the start year to 2021. And that will then bring me to the ability to see the pro forma tax return for 2021. And if you compare this to their actual tax return, it should be right on point if both the info that you entered and the info on their tax returns were accurate. Sometimes they don't match, which is always interesting, and always gets blamed on the accountant. It's never their fault. So you can go in here and see what their tax return is going to look like. So let's go to the 2022 tax return. This is what their tax return should look like in 2022, and it will provide you with a lot of information. I use this page for a couple of different things. Number one, I look at the data to make sure I put things in the right column, that I assign or attribute the capital gain income to the right person, or did I forget to reassign it when I changed some other assumptions in the program or some other data? So I make sure that everything is coming out on the right person. You know, is this Blake's other income? Wait a minute, let me go back and check that. This will also tell me their deductions and their AGI, or adjusted gross income. It'll show me their itemized deductions, which of course under current tax law, you basically don't get any itemized deductions except for maybe some mortgage interest. If altogether your itemized deductions exceed the standard, excuse me, a little drink of tea. And this will also give you the ultimate, what are their deductions for this year? And then if you were to change who gets the children, you would be able to see what that would look like, or if you change the filing status. So for filing status, you have to go back to enter data to change the exemptions. You can overwrite this and change it here. It's only going to change one side of the equation because we don't know what that would look like. But if we changed it to 2 and 2, we've overridden the data, and now our deductions are going to reflect that. Doesn't really change because there were phase outs. And I can always delete the overwrite and go back to the original data. It is not going to change the data. But what you have to remember also is that if you've done an overwrite, it could change anything that pulls from this page. So you want to make sure you don't keep any overwrites in there unless they're really intentional. And that goes for any overrides in the system. This will also give you a marginal federal tax rate, which is the tax on the last dollars in, and an overall or average federal tax rate, which is the tax on all of the income. It's just federal tax divided by gross income to give you a percentage. And those numbers sometimes come in handy when you're looking at other tax implications, and are good for that shorthand that we like to do on what's the tax rate that we need to consider for this. And make sure that you're not using a tax rate like, oh, let's take a third off for taxes. Well, no, the marginal tax rate for this guy is 24%. Why would I take 33%? So you can be the cognoscenti, you can be the one who knows the answers in your negotiations. And then this will also give you the total taxes. I get calls and emails often where people don't understand how their income after tax can be more than their income before tax. And that generally has to do with refundable tax credits. So sometimes their federal tax is a negative number. And if you go to this page, you will see exactly what their refundable tax credits were and why that would have been a positive number to them, because that is actual real money that they're getting from the government, not just their taxes that they paid in that are getting refunded, but credits above that are being paid to them. So there are non-refundable tax credits and there are refundable tax credits. And sometimes people are phased out of refundable ones. Sometimes they're phased out of non-refundable ones too, but usually not. And that can really change net income for those states that use net income for support purposes. And in Illinois, we have the additional wrinkle of having two separate types of tax calculations for net income. If you are using the gross to net table or standardized in Illinois, you will not see the refundable tax credits because as a matter of public policy, our HFS department does not include them in the net income calculation. So it can lead to very different results on those two tax calculations. In other states that use net income, this will explain that mysterious, why is the income more than she makes question. Now, I also want to explore with you the more reports pages, and that's at the bottom of the reports section in the reports, what used to be tab or overall section or folder of the menus. And the more reports page actually has 3 subpages. We've divided the reports into for lawyers, for planners, and graphs. And there's really no reason why lawyers can't use the planners page and planners can't use the lawyers page. They're just kind of organized there to make it easier to use. Now, on the lawyers page are the ones that we as lawyers might use more frequently. And I encourage you to explore these. There are some really interesting ones that I find myself not using that much, but are very helpful. So if you have a client who says, those numbers for the taxes are not correct, here's my pay stub, or here's my W-2, this is what was taken out for taxes, then you can explain why their withholding is different than our numbers for actual taxes. And, you know, basically it boils down to, if you're getting a refund, then the taxes that you're having withheld are more than the taxes you owe. And for support purposes, we really want to look at the actual taxes, not some mythical tax number that you decide to withhold. So we can go to the Form 4 calculation of wage withholding, and this will show what the wage withholding would look like, but it is not the same. And generally speaking, if I had to make a gross generalization about it, the IRS wage withholding intentionally over withholds so that people do get refunds and they feel better about paying taxes or less resistant to paying taxes. And here, if we change the tax status, it's going to change their taxes and going to change their withholdings. So this report sometimes is helpful to explain to clients why the numbers are different. We can also look on the planners page for a bunch of really cool reports. And the planners page has another feature that I really like, which is that you can check multiple reports or even all the reports in a section and have them all print as one PDF. That might be overkill, so let's undo that. And I'm going to show you number 6, the budget report, and number 17, the property statement. When I have the client do the data entry, and you do that by sending in the email at the beginning of working on the file to fill in the data, then they get to enter the data themselves, saves time and money for you and for them. And then you get their information, but it's never 100% correct. So what I do is I do report 6 and report 17. I set up each report with the options. So as you are learning the program and as you get in it, at the top of each report, you'll see, click here to set options for this report. This is the budget report. So when I set those options, I can include or not include any of these items. I maybe in the beginning, I'm not going to include maintenance and child support because A, they haven't been calculated yet. I don't have both sides information and I don't want to give my clients a heart attack. So I won't include that. I might include a subtotal for income after taxes. I like that one. Sometimes I'll include the mortgage payment or debt payment, even if it is zeroed at year end, because I want it to show up on the budget. So I will set it up that way and then go back and I will do the same thing for the property statement report. And then these two reports, property statement is all the assets and liabilities or debts. And the budget report is all the income and expenses that they've entered. And then all I have to do is go over here to the right side of the screen and click PDF. And it will PDF both of those reports as one report. And I send it back to the client. And then they can review it, make sure it's accurate and complete. You would then have two ways of having them update the information or add whatever is missing. They can go back in to the file and change it, or you can lock the file. It's a new feature in file management. If I go to my shared files, those are the ones that the client entered the data in. I can lock that file so the client can't go back in it and change any data. Or I can unlock it and let them do that. After I do this report, I, being sort of the mildly control freak that I am, prefer that they give me the information and we'll make the changes. Usually it's not extensive. If it's extensive, I might let them do it. But there are a lot of other reports here too. For the financial planners in the crowd, we can show liquidations to cover negative cash flow and how their assets are going to get used. I don't have anything in here right now, but there are a number of data settings in the assumptions for these things, and you can see what that is going to look like, as well as reports on financial investment liquidation, IRA 401k liquidations, which you can set to show the 10% penalty and the taxes on liquidations from the retirement account. Again, depending on how many years you go out, those reports will reflect that number of years. We can look at what is this settlement going to look like for the next 5 years. Oh, that looks pretty good. But now if we went out 50 years or 10 years, we could show what that looked like, and it might look very different. So there are a number of very cool reports. Somebody just the other day emailed me and wanted to know if we have a real estate sale report. And in fact, we do. You can indicate a property is being sold, and then it will be able to calculate whether there would be any tax due based on the price and the basis that you put in. Obviously, for those things, you need certain kinds of information that clients don't always give us. We have lots of backup reports on calculations for taxes, income from real estate, financial investment income, 401k payouts. And again, this would have to go out enough years to reach the payouts, but we can't do that without the data being in there properly. So let's then turn our attention to talking about entering data properly. And I am just going to take a glance at the questions and annotate. My colleague is going to be monitoring those questions, the Q&As and the chats, and be able to answer those questions. Nothing I need to attend to right now. So let's go back to enter data. So as you're entering data, you want to look at the information on a granular level for what we're looking at today. So yes, you put in the debts, the checking account and investment account information. And for some states, we've reordered this data entry so that it sort of flows in the same order as the state's financial affidavit. Not every state has that. I find it somewhat annoying, but people like it. So we're doing it for you guys, not for me. So we go into, let's say, the checking account and investment account information. And what I want to talk to you about today is the more info screens. So the more information screens you find on the green box with the 3 dots, or on the desktop program, it'll say more or more info or more information, depending on how much room we have for you to see those words. And if I go into, let's say, this Bank of America account, I can put in information. Is there a debt or lien against the asset? Is there annual income or an annual rate of return? Now I can change that so that it's different rates for different years, or I can put it in so that it's the overall assumptions. So remember, a few minutes ago, we looked at the assumptions page, and there are overall assumptions. So I'm going to go back there for a moment and show you that we have assumptions for an inflation rate, assumptions for a default mortgage interest rate. And if you click on the little question mark, it will give you information about that inflation rate. Now, interestingly enough, right, we are using what is currently an extraordinarily low inflation rate compared to what we are all paying when we go to the grocery store or the gas station. We're only updating this once a year based on CBO projections. So those are usually fairly conservative because, of course, the government doesn't want us to think that inflation is long-term. But you are free. Anytime you see a yellow box, that's a data entry field. So you can change your overall inflation assumption rates, and it will use those for all of the projections, unless you set a different rate for each asset, liability, income, or expense. And that's really the point of what I was going to here. So I'm going to change, I'm going to change this back to our 2.6 conservative rate. But know that anytime you see a yellow field, you can change things. Now we also have interest rates on accumulated savings. So there's a rate of return for interest, for dividends, for capital gains, for tax-free income, and appreciation rates. But those don't apply necessarily to every asset in your portfolio. So when I am entering data on assets and liabilities, I might have this JP Morgan account, and boy, that's doing really well. My investment advisor is a magician, right? I wish. So maybe for this one, I want to put in a 4.3 rate of return. And that's what now the program is going to use for this particular asset. For overall, for other assets that you don't change, it's not going to, it'll just use the basic rate that's in the assumptions. But the individual assumptions, you can also do a rate of appreciation. Maybe there's actually an overall rate of return is only the 3.2, but our appreciation rate, you think it's growing 8% a year. You know, you've got some great stocks in there. So you can set those individually. You also want in this to be able to identify, if you want to, number of shares, if it's a particular stock. I have had some situations where maybe we had a JP Morgan account, but within that account, there were different holdings and they were dividing the holdings as opposed to the whole account. So rather than have just one entry, I had multiple entries. And so for each one, we were putting in the number of shares and dividing it. It was fairly complex. You want to put in what the tax category for the income is going to be. You also want to mark if it's a pass-through for eligible for a pass-through deduction. Important if you're looking at capital gains, of course, is to put in the basis. Oftentimes our clients have no clue what we're even talking about when we ask them about that. But sometimes you can get that information from their advisor or their accountant, or make them search the records. This also, in more info, will allow you to set something as separate property. You can do that from the front page of the asset. If you go into data entry options for the page and set that you want to show fields for separate property, for example. Now I can close that section. And here I have the check boxes if I want to make this whole thing Taylor's separate property. It immediately assigned it all to Taylor and it turned blue because now we're calculating that it's all Taylor's. But if I go into the more info and I go down to that separate property, maybe not all of it is separate property, maybe 2,000 of it is separate property. And then I could enter that much would show as separate. And then the marital asset part of it would only end up being 6,700 instead of 8,700. And the program will automatically do that for you. So there's lots of flexibility here. Now, the more info screens are context sensitive, which means that when we were just looking at an investment account, it's going to ask me certain questions relevant to that. If I go into a business, it's going to give me business kinds of questions. So the first thing we're going to want to know, what's the form of the business? Why is that important? Well, in Illinois, it's on the financial affidavit. Why? I don't know, but it is now. But it also is going to tell us about taxes, because for those of you who remember that really fun Tax Cut and Jobs Act of 2017, we entered the world of qualified business income deductions, which has to do with what the form of the business is. So now when we enter the value of the business, we can look at the tax basis for property division after tax. If there's untaxed capital gains, we can, I'll come back to the income aspect of it, but we can also put in, when we scroll down here, are there qualifying capital assets? Because that's going to impact our QBID or QBI deduction. And you can also say, is this business exempt from net investment income tax? You can say whether it's going to be a pass-through business for the QBI, and is it a service business? So that changes the QBI deduction. So all of these fine-tuning of the information is in your more info screens. So definitely explore those, get to know those, to really make your information more accurate, more complete, and more valuable to use in figuring out what is the best result for your client or clients, especially for mediation cases. It's great to have really accurate information. Now let's talk about income from businesses. So anytime I have an income from a business, I like to put it with the business. I put in the business as an asset, and then I maybe just put in the dollar amount of the income or pre-tax net cash flow. But often what I like to do is list them separately and use the income and expense worksheet. So I check this box and I use the income and expense worksheet. And then what we're doing here is we're essentially replicating the Schedule C or the 1065 return for the business, and be able to put in detail if we want to, and then just print this report. Or I can just put in on one line all the expenses and have it go that way. I can separate out depreciation and depletion, because certainly those have different tax implications, and also for support, we may want to be adding those back. I can also separate out personal expenses here, so I can know what I'm adding back as well. And then you will get a taxable income or loss number of 15.6 here in this sample, which is going to carry over to our more info and is going to carry over to our front page, and then we'll carry over to our budget report as income from the business. And here is that business going to Taylor. And then I say, oh, wait, no, it's really Blake's business. I just would go in. We'll talk about that in a minute, how to assign assets. Let me use that as a segue for what we're going to do after I finish this section of today's training. Okay, so there are lots of reports here. I encourage you to look at those reports and get to know what's there, because those are tools that will help you to do a better job in your practice for your clients. I have some favorite ones for mediations, for example. I may like to have them focus on major expenses if I've put in some child and major expenses, to just look at those separately. Or if we're not using maybe guideline child support, but I might want to look at allocating the children's expenses separately. I can look at the budget report for children, and this will then have everything I've put in for the children. This particular sample file is a little light on children expenses, but for most of my real cases, I'm going to have 20 or so different items here, and we can then look at how those get allocated or how those compare to child support itself on guidelines. It's really helpful for me. I like to use that one for mediations a lot. Okay, so now we've looked at reports. Let's look, and we've looked at entering the data to look at more info screens. And I'm not going to go through every single more info screen. I will say that there are often state-specific items in those more info screens. So for example, if I go to assets and liabilities and I go to the real estate and I go to more info, now there's a bunch of different information. If I go to separate property, this is an Illinois case, so there's not a lot of detail here. But if I were in California, this would be giving me a link to a more Marsden calculation, which is similar for my Minnesota people to the Schmitz calculation. So there's more detail to figure out what you need in these more info screens for certain states. And that is very cool and very helpful. So now you've entered the data, you've seen your basic reports, but you want to play around with it and see what would be best for the client. So now we're going into the analysis tab, or what used to be the analysis tab, the analysis section. And here we have some different sections of this analysis tab. So let's start with the last one, which is property. and look at the divide property worksheet. Now, there are a couple of ways to work on dividing the property. When you enter the data for assets and liabilities, if you remember, we looked at data options for the page. There is the ability to show fields for financial affidavit, for separate property and valuation date, but there's also the ability to allocate assets automatically, either 50-50 or by title. This only works for assets that are added after you make this selection. So if I were to change this to go by title, let's just say that that was Taylor's asset and I did it by title, it's not going to change my allocation. It's only going to change what is new. Okay. And so that's one way to allocate assets. A second way would be to do it asset by asset. We're going to divide the house equally. Okay. We're going to go into the checking accounts and we're going to make this one go to Taylor, and I'm going to make this one go to Blake. So you can do it individually. But what I like to do is I like to look at the whole picture. So I go into the analysis tab, I go into divide property between the parties, and this allows me to do what I consider to be a souped up spreadsheet on steroids. Okay. So first I like to start with a bar chart and these two checkboxes unchecked. So this is my basic list of marital assets. So anything that you put in as separate property won't be showing up here. And you can see, remember, we put $2,000 of the $8,700 in this S&P 500 fund as non-marital. And sure enough, our marital balance sheet is only showing $6,700. And I like to start with the bar chart because it will show me anything I haven't yet allocated. It'll show me it visually with this yellow bar. It'll show me it with numbers and words. Whatever my learning style is, we have a way to address you, unless it's oral, in which case you're out of luck. And here's my balance sheet. And I can move things around either by percentage or by dollar amount. I can say, I'll just make it 2,500 so I know what that's going to come out to. Oh, it's not letting me because it's a negative number. Sorry. We'll do this one. I'm going to change this to 25,000, and that's now going to automatically do 50-50. I can take this 123,000 and say 100,000 of it is going to go to Taylor, and it'll automatically calculate the percentages on both sides of the equation. So that is very handy. We've now allocated all of the assets and the yellow bar has gone away. Maybe now I might want to show that pie chart that shows what the balance is. And I see that I'm not at 50-50. Do I want to be at 50-50 or some other percentage? I can click this box and it will automatically, the top one here, show how far the parties are from 50-50 or other target. And now to get to 50-50 for Taylor, party one, I am going to need to move $25,000 over to Blake. I can do that by adding $25,000 to Blake's side of the balance sheet, or I can leave this as a cash to balance, an equalization amount. If I wanted to do a 55-45, now we only need 3175 to Taylor to get to that target percentage. So that's really cool and handy. Sometimes I might like to allocate assets by asset class. So I might want to do 50-50 on retirement, but a different percentage on non-retirement or a different percentage on debt. So the overall percentage is not my target, but the asset class percentages are. And to do this, it's slightly less automatic, but I would just be moving stuff around. So let's say I gave her 40% of the house, or sorry, 40% of the house. Now she's still got 53% of the other assets. So maybe I'm going to make it either 38 or, some other smaller number. Maybe I'll start by looking at 35. Where are we on that? We're pretty close here. And now maybe I want to show how far the parties are from 50-50, but I'm not allocating the debt equally. So the 50-50 is going to be skewed because the debt is going to go into that balance sheet. So sometimes it's better to look at these from a asset class perspective. Now, sometimes you want to look at different options for property division. So we have the property division scenario page. This allows you to put side-by-side scenarios. You can either copy one of the scenarios. So I can copy scenario 1. And now I have 2 the same. And now I can make some changes. Or I can do a lot of side-by-side scenarios. Let me delete that one that I just did. Swap 2 for 3. And I'm going to delete that one. Okay. And maybe on this one, I want to give Taylor 50% of the house and see what that's going to look like. I've changed the house value. I can make that consistent, or I can look at what would this property division look like at the different values that the parties are advocating for. You can do this for any of the assets on our list. Now, whatever is in this actual column is what's going to show up on my report of marital or community property division. And that's your sort of your end result. So when I am in the analysis screens, I want to play around with these different scenarios. This is great for mediations when they're deciding who's going to get what. And now you can swap once you have a scenario that you like for the actual. And I can swap scenario 2 for the actual. It's going to flip those 2 columns. And now this one is going to be the 54 to 55, 55, 50, 45 split. And you can use that now in your property division between the parties and come up with the 50-50 split, the amount to cash to balance, and use that in your case. So property division scenarios is something I use a lot. It's very handy. One tip is label your different scenarios so you know what changed, so that when you start swapping them around, you don't forget which column was which, or only I do that. We can also look at dividing property on an after-tax basis. And this allows us, the program will automatically look at marginal tax rate at retirement. So what is that really going to look at? It's going to take into account all those assumptions that we looked at earlier to figure out a projection of what the income is going to be at retirement. Obviously, retirement being an age that you've entered in or a date that you've entered in, and figure out what their tax rates are going to be at that time using current tax law. Obviously, anytime you're doing this, you're using assumptions. This also will allow you to look at a current capital gains rate, which again will require the basis to figure this out accurately and give you the tax rates. You can look at detailed explanation of those taxes and then look at each asset and see if it's impacted by a tax that would change the value to either party as an after-tax value. So if you're trading it off for a pre-tax asset and an after-tax asset, you can do it in a fair and equitable way. Okay, let's spend a little time talking about alimony. Let's talk about alimony. So when it comes to alimony, we have a couple of different ways of looking at it that are really helpful. Now in Illinois, of course, we have guidelines. Most states do not. Alimony is always sort of a black hole of whatever people think is fair, whatever that means. So we have a lot of ways of looking at it. First is spousal maintenance break even. When we look at the break even page, this will tell you, based on the income and expenses that you've entered, what that party will need to break even or meet their needs that you've put in the program. Obviously, that's a loaded word in our business. So it's a starting point. Maybe that would work, maybe it wouldn't. And you have a nice assumptions and explanation here. So if that were the case, this is what their net after tax would look like. And maybe then Taylor says, well, that's great. I have nothing left. He has 4,800 left. That's not fair. So let's look at some other ways of doing alimony. We can meet recipients' need. What that is going to do is look at a desired amount of recipients' after-tax income and tell you how much maintenance is going to be needed to meet that need. So let's say that we'll start with 90,000. Well, she's going to need $4,300 a month of maintenance. Blake says, yeah, that ain't happening. So now you can look at other numbers, other scenarios. You can show as many columns as you want. You can change the numbers. So 50 may be a little too low. Let's go from 70 to 60,000, and it's going to give you that result. And based on all of these, you have your detail, your short detail of the support impact. And then we can go to an expanded report, which will show you more detail on the income and deductions and percentages of income that are coming out to do this. And those are very good, handy ways of looking at alimony. But we have another way that's, I think, even better. I like even better. And that is, what is the split of after-tax income? And how much maintenance do we need to get to that point? So here we can say, well, we want this to be fair. Fair to me is 50-50. So this is how much maintenance I would need to, Taylor would need to have 50% of the after-tax income. And then, like in Illinois, we have a 40% of combined after-tax income soft cap on alimony or maintenance. So Blake says, no, we're going to go this way, or Blake's attorney, and you need $700 a month to get there. And then here we are splitting the difference. I just did it this way, but you can show columns, you can hide columns, you can look at the short detail or the expanded report. We also have a present value. Forget this monthly maintenance payment thing. I am not doing this. I want to just buy out your maintenance. What would that look like? And of course, that depends on the amount and duration. So I can go back to my actual spousal support, link right to spousal maintenance to use. And if I'm using calculated maintenance, great, but maybe I don't want to calculate the maintenance. Maybe I want to put it in myself, or in states where we don't have guidelines. So this is Illinois, we have guidelines for maintenance. I don't want to use the guidelines. I want to put in my amount here. So I'm going to say it's $1,700 a month. And let's say it's going to go for 10 years. And now I can go to the present value down here, or I can go back to my present value report and say, okay, I'm going to be using this actual amount. Here's the present value. Or I can use any amount that I want. What would $2,500 be for that period of time? And I'm going to update this. And here's my value. Now you'll notice that the value is the same for Taylor and Blake. That's because maintenance is no longer taxable. In some states, maintenance is still taxable and deductible in the state for state tax purposes. And that is built into the program. You make those selections. But what you can also do here is you can play around with the only variable, which is the pre-tax interest rate. So I could say, well, what would it be if it was a 2% rate? And you can see that now the values are different because the interest rate changed. So I can look at high rates, which lower the value, or low rates, which raise the value, and see what that is going to look like, both in terms of a graph and also in terms of the dollars. And we have a beautiful explanation report here that will give you all the detail for your clients. And if that's not enough, we have a super detailed report that gives you all of the calculation in text, essentially, for the super nerdy among us. Okay, so we have about 10 minutes left. I'm going to take a quick gander at the rates. The pre-tax interest rate is not a tax rate of the person. That is your discount rate, or the cost of money, the cost of funds, because what you're really figuring out in present value, what the discount or the cost of getting the money now versus a stream of payments over time. So if I were to get a stream of payments over time, I would not have use of the money now and be able to invest it and receive a return. But I would have to pay it out over the course of years. So the cost of money is what we're really looking at for that interest rate. Okay, so now I want to just get to the what if for child support. And this is helpful because this is going to give you both a spousal maintenance amount and a child support amount. I've left the guidelines checkbox off here because most states don't have guidelines. And what you can do here is you can change any of the variables that go into child support for sure, and maintenance in part, that what might change the results. So you can change filing status, you can change overnights, you can change who's the majority time parent or getting the tax exemption. Remember, of course, the tax exemption itself is worth zero, but it comes with the tax credit, the child tax credit. So it could make a difference. It also could be phased out at higher incomes. So you want to look at that as well. And you can make all those changes and then see what the difference is in the support amount. I have used this for different overnights. I have used this for changing the dependent exemption. I also use it if we're looking at what about the bonus? What would the bonus look like? So I'm going to delete these two scenarios that are in the program right now. And I'm going to add a scenario, and I'm going to leave everything the same, except that instead of $12,000 of bonus, I'm going to say, what happens if there's a $50,000 bonus? What is that going to look like? And now I've got my support result for that. You want to label these again, just like I said before, so you remember what the scenarios were. You can do this for your overnights. who's the majority time parent, any of those things. Do side-by-side scenarios. And then again, when you get to the one you like, you can swap it for the actual. The actual is what will be on your child support worksheet. You can also PDF or print any scenario or the whole page with the side-by-side scenarios. Okay, let's look at the Q&As. In the Q&A, how did you select the option for 50% allocation of after-tax income for maintenance? So meet recipient need page is a dollar amount. Balance incomes is a percentage amount. So if I'm doing maintenance and I want to automatically say, let's go and see what a 50-50 split of after-tax income would look like, how much maintenance would we need to get there? The balance incomes page will tell me that. The meet recipient need page is looking at dollars. What dollars do we need to get to a 50-50? So it just happens that my second scenario here turns out to be about a 50-50 difference. It's rounding that's changing the number a little bit, but they should pretty much be the same in those two scenarios. So it was 2000 versus 2166. And mostly it's because there's some different rounding going on in each of these different scenarios. So I hope that answered your question. Anna, did you have something else?
Hey, Nancy. So David had a question to go back to the alimony present value in the chat.
Okay.
He said, if you are doing an alimony present value calculation to see how much should be maintained to protect it, shouldn't the IR be 0%? Was his present value question for alimony.
Well, it depends what you do. Yeah. So yes and no. So if you are looking at a number, like how much life insurance do you need to have to secure this stream of payments? You are looking at today's present value, but you are also looking at, these are not all payments that would be received today. They would be received over the course of time. So there is a discount rate or a cost of funds that would be involved in that calculation. I mean, but certainly there's nothing wrong with saying my starting point is the sum of all of the payments, as opposed to the discounted present value. That's the difference between those two things. I have had a question in the Q&A for the file manager. And so I'll spend a minute or two on that. So if we go to file manager, I've got my own files. If I have the firm edition, which I happen to have the license for, I know somebody, I can click on all firm files, and that would give me everybody's files in the firm. And then there are shared files. Shared files are the ones that the client started. And whichever one I'm in, I can start opening a new file, which is either to start a new file myself with data entry or to register a client for their online data entry. So I click on new and I have a choice. I can either do a new file, put in their names, the state, and then a new feature is you can name the file itself. So if you do different versions of the file, they would all be searchable and be found together. So I can put in a file name, and then I would create the new case file if I'm doing it myself. If I'm registering the client, then what I want to do is put in the client's information, including their email, and register them. And that then sends them an email with instructions for data entry. What will also happen there is that you, as the licensed user, will get a confirming email that you have sent your client the web data entry. When they get it, they will be able to set their own password and enter the data. So if we go into enter data, you will be able to see the data. Oops, got to change files. I keep forgetting I have to do that. I'm going to go into a shared file. This is just a really very sketchy file. And I can see this is what they're going to see. Enter your information. Here's all the sections. They open each section, put in the information for each of them, and then they can mark each section done. They can mark this done. When they're all done, when they start working on their data entry, you will get a second email from Family Law Software saying your client started working on their data. I always laugh because they've been telling me for 2 weeks that they've been working on it or more. And I know they haven't because I haven't gotten that confirming email. So when they start working on it, you'll get a confirming email that they're working on it. And then when they're done, they will click done for now. And that emails their professional to let them know that you can go ahead and start working with the data, start looking at it. So then you would just go into File Manager. It would be a shared file, and you can just open it up like I did just now. And you can also archive files. And this also will show you all our automatic backups. Now, we have a couple of other features. We can look at the history, which will tell me every time I've opened the file and worked in it and how long I was in it. I know none of you are as bad as I am at keeping my billing time, but this is a really good double check on how long you were actually working on a file. You can also switch for the paralegals or staff in our viewing audience here, whose files you want to look at. Here I only have mine, but if I had multiple users in here, it would allow me to pick somebody else's files to work on. And then under action, let me just go to my files because there's more of them. If you click on this 3 dots, it brings up a whole menu that allows you to rename the file or the case, to look at the history. You can download it if you want to use the desktop version. You can make a copy. You can email it to someone. If I ever ask you, if you call me for tech support or email me and I say, hey, email me your file so I can take a look at it, here's where you would go to do that. And it'll also allow you to archive the file so it will show up in your archives page. Okay, so that is our new file manager. And then you asked about locking the file. Simply go to the shared file under the lock column. You can just click on the little lock and it will turn red and tell you that it's locked. And when it's not locked, it'll be blue and smaller. Okay. All right. I know there's lots of questions. Anna, do we have any more questions we need to address?
I think we got all the questions. The only one that I wasn't sure if someone had asked if we did any major updates to the pension valuation screen. I answered that I didn't think we had done anything, but if you could comment on that.
Yeah, a little bit ago, we took out one Colorado mortality table that they don't use anymore. So when we get to the pension plans, and I didn't have time to cover that today, when you go into more information, we have multiple mortality tables to choose from. And here again, we have a discount rate to use. This uses a 20-year T-bond rate. And you can obviously change that or use multiple tiers of rates. And we have multiple mortality tables, which allow you to see at a quick glance what they are. For those of us who are not actuaries, we have no clue what those things mean. You can click on more information and it gives you a little more detail about those different mortality tables. I usually, when I'm doing it, just use the most recent one. But what I like to do with clients is sometimes show them how the value can change when you change the mortality table. So the fact is that this isn't a real value. It's not real money. It's a present value assumption. Okay, that's our program. We only went 5 minutes over. Thank you all for attending. Please let us know if there's anything we can do for you or help you in any way in your use of the software. You can email support@familylawsoftware.com. Also check out our website and the help support information there. Thank you.